Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of July. July tends to be positive in the first half of the month on a seasonal basis over the long term on average coming into earnings season. Now, I want to take a look at that trend, but I also want to take a look at a recent trend that's been developing that goes against that a little bit. I want to try and measure that out between the two of them. I also want to take a look at the sectors of the market which tend to perform well in July and August, and also which sectors tend to lag the market overall as well. So let's jump right in. We're going to take a look at my Thackeray's 2022 Investors Guide as a reference point. Here we can see the S&P 500 for the month of July from 1950 to 2020. This is the average graph. Every year is different, of course, but this is the average graph. And you can see that the first half of the month it tends to be positive over the long term. This is primarily because it's an earnings month. So January, April, July, October tends to be earnings months, and the stock market tends to rise into earnings. Now, it could be different, of course, this time around, and there is a concerning factor that has been developing recently. This is a graph of the S&P 500 over the last year. And you can see here, starting in 2022, what took place was in December, the stock market rose into the end of the month, which is often a seasonal pattern. And then what we saw was the stock market head down as soon as the month started. And then we take a look at what happened in January, the same thing. We saw that rally into month end, and then we saw the stock market head down. Now, typically, you would get a few days of positive returns on average over the long term in the first few days of the month. But that's not what was happening here. This was just a couple days after. It did bounce back up again, but then fell again. And then in February, once again, we saw that just peaked just 1 or 2 days after month end. And then the stock market head lower again. Then we saw that rally in March, and then it peaked actually before month end. So we saw that rally take place, and then we saw before month end. So what we're seeing is we're seeing a lot of these month ends rally into month end, and just before month end or just after month end, we're seeing the market falter a little bit. And look what happened in April. What we saw was the stock market have a little bit of rally here, and then peaked in early May, and then we saw the market fall back down again. And then in May, what did we see? We saw this rally coming into month end once again, and it came up and down a little bit of volatility. It really had the peak at the beginning, a couple days into May, so the start of the unfavorable 6-month period for the stock market. Then we saw the stock market fall again. Now we've seen a little bit of volatility here, but it's possible that we could see the same trend play out coming into July as well. The July 1st was positive for the S&P 500 on a seasonal basis. The first half of July tends to be positive, but we are seeing this trend taking place of month-end rollovers just before month-end or just after month-end has finished as well. So something to watch out for. And if we go back on a fundamental basis and take a look, we look back at the previous earnings season, we did see a lot of CEOs giving weaker guidance on a go-forward basis. So investors are very concerned about what's taking place in the market. So if there's going to be a summer rally, because a lot of people talk about a summer rally and the media talks about a summer rally, this is when it takes place. It really takes place from the end of June, the last couple of days in June, and into mid-July. You don't really see a summer rally take place in August and September. That's not when it takes place unless you're coming off a recession, and that's not what's happening here. We may be heading into one. But if there's going to be a summer rally, this is typically when it would take place. But right now, we're seeing a little bit of trepidation in the marketplace. The last week of June, coming into the first day of July, we saw utilities leading the way. Investors are really concerned with the overall market. So we're seeing some patterns here developing that says that even though there's a seasonal trend in the first half of July for the month to be positive for the S&P 500, it's possible we could see that falter early. And what does that mean if it does falter early? Because it doesn't always work. It does work on average over the long term with a fairly high frequency. But what does it mean if it doesn't work? If investors can't push the market up higher coming into earnings, that tells you that investors really are concerned and they don't have a lot of conviction in the marketplace, and there's possible weakness ahead for the overall market. Okay, so let's jump right back in and take a look at the sectors of the market here. This is the table of the major sectors of the S&P 500, and it's ranked based upon the greatest average gain, in this case from 1990 to 2020. If we take a look here, financials is the top performing sector in the total month of July. Then we have information technology materials. But I do want to point out a couple things here. First of all, on the frequency basis, there's not a big discrepancy in these numbers. They tend to be a little bit below 50 or a little bit above 50, but there's not a lot of numbers where you see 80% success rate or a 30% success rate. It really comes down to, in this case, if we take a look at the numbers here, financials on top, and then it goes down a little bit lower each time on average, but it's the success rates that's concerning. So we don't see a lot of sector leadership taking place, at least in the broad, big sectors of the marketplace. And from year to year, it can be a little bit different overall. In the bottom here, we have utilities, tends to be one of the weaker sectors. But once again, in this case here, it has a 45% success rate of outperforming the S&P 500. So this last column is the frequency of outperforming the S&P 500. So if we jump down and take a look at some of the subsectors of the marketplace here, let me just put this up here. We can see here that in this case, the biotech sector. Now, the biotech sector has a 79% frequency rate of outperforming the S&P 500 in the month of July, and that's from 1993 to 2020. Let's take a look at the biotech sector here, because it starts the seasonal period on June 23rd. And here, I want to show you this graph here. This is the monthly returns for the biotech sector from 1993 to 2020. And the bar represents the average, the cross represents the median. And look at for the month of July. The month of July tends to be very, very positive for the biotech sector. It doesn't mean it happens every time, but just on average, it has a high average gain, a high median gain, and its frequency of success on an absolute basis is 76%, and relative to the S&P 500 is 79%. So very positive sector on a seasonal basis. Where do we stand right now for the biotech sector? This is a graph of the biotech sector using the ETF IBB in the US. The second panel down here is IBB relative to the S&P 500. Now, if we take a look here in the relative graph to the S&P 500, you can see the biotech sector has underperformed the S&P 500 since, well, let's call it early 2021. Did have that initial bump up here at the beginning of the pandemic, and then we did see some flatness up and down, of course, but then we've seen this underperformance taking place relative to the S&P 500. Now, if we take a look at the seasonal period for the biotech sector, so June 23rd approximately, and then September the 13th for when the biotech sector ends its seasonal period. In this case here, you can see it outperformed the S&P 500. Look what happened after the finish of its seasonal period. We did see the biotech sector underperform the S&P 500 again. Now, in this case, we started to see in May, we did see the biotech sector outperform the S&P 500. And so it's been putting on a solid performance since early May, but that might mean maybe the biotech sector could finish up a little bit early in the seasonal period. But nevertheless, July tends to be that really, let's call it the sweet spot to the trade on a seasonal basis for the biotech sector. So we've seen some positive momentum into July here. So let's see if the biotech sector can keep that up. Another sector that stands out in the month of July is the agriculture sector. Now, the reason I say that is that it's at the bottom of this list here of sectors, selected subsectors. It's obviously not a complete list of subsectors of the market, but it's just a selected list here. And you can see here that the agriculture sector only has outperformed the S&P 500 45% of the time, in this case from 1994 to 2020. Now, there's been a lot going on with the agriculture sector, and the fundamentals could overwhelm what's taking place. But if we take a look here, even in this case here, 48% of the time it's outperformed the S&P 500. So even though it's in this case at the bottom of this list here, it still has a fairly good chance of outperforming the S&P 500. But its strong seasonal period starts in late September. It can start early, of course. I'm using MU in the U.S. here relative to the S&P 500, and we saw that really strong performance with a lot of the commodities, including the soft commodities and agriculture here, outperforming the S&P 500 into April, and then we've seen the sector turn down. Now, there's the war with Russia and Ukraine, can really change things up here a little bit. But even there, we have seen in the month of June, we have seen the agriculture sector pull back down. It isn't the best strong seasonal month for the agriculture sector, and something to watch out for from that perspective. The other sector I want to talk about is the gold sector. If we take a look at gold here, we can see that gold has outperformed the S&P 500 52% of the time from 1990 to 2020. Now, gold starts a strong seasonal period in the month of July, and it runs from July the 12th until early October. And sometimes it can finish up earlier than that. And the real sweet spot to the trade is really August and September for gold. Now, let's take a look and see where gold's developing its technical pattern here, and possibly what could take place in its strong seasonal period, which is fast approaching here. Okay, so here's gold up here by itself on an absolute basis, and this is gold relative to the S&P 500. Let's take a look at the absolute basis here. And if we take a look here, we can see that, well, let's start with the relative basis. You can see that gold's actually done quite well relative to the S&P 500. But in essence, really, gold is fairly flat for the year 2022. We did see that run up take place and some of the geopolitical premium from the war when it first started pushed the price of gold up, but we have seen it come down. And it should be noted that we've got lower highs here as well, which is not a positive pattern for gold. So we could see gold pull back here a little bit from that perspective. And we are getting close to the support level here, just around 1750, a little bit higher than 1750 as well for gold. Now, in this environment with rising interest rates and a stronger U.S. dollar, gold's actually performed relatively well and holding its own. But we still don't see a really strong technical pattern at this point. It would be good to see gold actually come back up here and go above 1850. And on strong volume as well, where investors were really pushing it higher. That's what we'd really like to see for gold. I want to show you this graph for gold from 1984 to 2020 here. On a monthly basis, you can really see here that on a mean basis and median basis, August here and particularly September tend to be the best months for gold. Watch out for October. I know the strongest seasonal period for gold can run into October, but we have seen some negative October surprises for gold as well. So we're coming up to the stronger period for gold. We're starting its strong seasonal period. We haven't really seen gold perform well on an absolute basis heading in early into this seasonal period. There's been a lot of factors going against it. You know, a strong Federal Reserve pushing rates up higher and combating inflation and convincing the market that's serious about that has been a damper on the overall price of gold. But we are coming up to the strong sweet spot for gold. And depending on what happens with the Federal Reserve, a lot of investors are expecting the Federal Reserve to pivot or at least start to back off its strong rhetoric, perhaps in Q3. So we'll have to see what happens here, and if that were the case, that would actually probably really benefit gold as well. I want to show you this chart of gold miners. This is GDX. It trades in the U.S. This is GDX relative to the S&P 500, and this is GDX relative to the price of gold bullion. What's important here is that GDX, or the gold miners, have been underperforming gold bullion. What you'd like to see ideally is the gold miners outperforming. That tends to give gold a bit of a boost. That has not been the case now. That's partly because we've seen the overall stock market heading lower and investors selling stocks in general, including the gold miners. But if we'd like to see the gold miners start to improve their performance, even so, because gold miners are underperforming the S&P 500. So the gold miners have a strong seasonal period that starts late July, from July 27th, and runs until late September. So we want to take a look at what's developing from that perspective and see how gold miners are starting to improve their performance relative to gold bullion, particularly if the stock market starts to perform well. We definitely want to see that take place as a positive attribute for gold miners, where they start to outperform gold bullion. I want to show you the VIX, the volatility index, and this is from 1990 to 2020. And this measures the volatility of the market, the S&P 500 implied volatility of the S&P 500 using options. But what you can see here is that from 1990 to 2020, on average, the average year, you tend to see volatility starting to pick up in July. It doesn't happen all the time, but on average, it tends to happen around this time of the year. And so it's something to watch out for. Volatility actually peaks in October. And we've seen that in the past. We've seen a lot of surprises in August and September with the market heading lower at that time and even rallying back up and heading down again. So on average, this is when we start to see volatility pick up, something to be watching out for. So where do we stand with volatility right now? Okay, here's the chart of the VIX. Okay, and this is the S&P 500. And what we've seen is as the S&P 500 has come off the pandemic, we've seen volatility heading lower. And as the S&P 500 started to head lower at the beginning of 2022, what we've seen is volatility heading higher. Now, it's interesting that we still haven't hit this 40 threshold. A lot of investors look for the VIX to get 40 to show some capitulation in the markets. And it's been very interesting to see that we really haven't seen volatility, at least from the VIX level, picking up despite the stock market entering bear market territory. And so it's a little bit unusual from that perspective. But given that volatility tends to pick up at this time, if we see the stock market heading lower, we could actually see the stock market, I should say the VIX, get to 40 and above 40 as well. I just want to say for the month of July, the first half, as I said before, tends to be positive, although we may not see that strong positive return that we've seen in the stock market in the past on average, with everything that's going on here a little bit. So it's a little bit of time to be cautious despite some positive seasonality at this time. Now, the big warning really is August and September, which are right around the corner. And so the second half of July, the stock market tends to sputter out a little bit, and then we start to see some negative performance on average for the stock market for August and September. And that's really when volatility starts to really pick up as well. So I call that the dead zone because you really need to have some positive stimulus, whether it's the Federal Reserve providing the stimulus or the government with big spending packages, something to drive the market higher in this time, in that time period for large gains to be made. And that's not really in the cards at this point right now. So we could see some trouble ahead. And as I mentioned earlier too, if we don't see the stock market perform well in the first half of July, that can be an indication that investors really aren't comfortable with the way the economy is going and earnings, because earnings are translating back, the economy strength is translating back into the earnings. And if we don't see investors push up the market on earnings and the earnings don't come through, investors may say, well, what is there to keep this market higher? We know the Federal Reserve is tightening and it's just started its quantitative tightening program with buying bonds and it's been raising rates. So what can push the market higher? And so we might see the markets actually suffer a little bit in August and September as well. Of course, that can lead to a positive opportunity. I want to be a little bit positive here at the end. If we do see that take place, September lows can often be a good positive opportunity for the markets. We're not there yet, but it's just something to think about for the future. Thank you very much for joining me today.